Hello and welcome to Prosperity Capital Advisors' second quarter market intel report for 2026. I'm Dave Allison, chairman of our investment committee. It's been an eventful start to the year. Conflicts in the Middle East triggered oil supply disruptions, inflation concerns resurfaced, technology stocks swung sharply as markets started picking AI winners and losers. The headlines have been loud. But when we look past the noise and focus on the fundamentals, growth, earnings, and the direction of inflation, the picture is more constructive than you might expect. Let me walk you through what we're seeing and, more importantly, what we're doing about it. The US economy remains resilient. GDP growth is running around 2%. Economic data has been beating expectations, and a key driver underneath all of this is the productivity boom that's been building since mid-2023. We believe artificial intelligence is a big part of that story, and we're only in the early innings. On inflation, yes, the headlines moved higher because of the energy prices, but core inflation, stripping out food and energy, is around 2.5%. The broader trend is still moving in the right direction, just unevenly. The Fed is on hold, and we expect them to stay there for now. They've told us rates are already restrictive, and their latest projections point to just one cut this year. The next move is more likely down than up, but they're being patient, and so are we. On the markets, the big story this year isn't the index level. It's what's changing underneath. For 2 years, a handful of mega cap tech names drove almost all the returns. That's shifting. In 2026, the market is broadening. More companies are participating in upside. Earnings growth is showing across sectors like energy, materials, and industrials, not just technology. That's a healthier market. Within tech itself, the dispersion has been dramatic. Semiconductors surged while software stocks fell hard, a nearly 30-point gap. The market is actively sorting which business models benefit from AI and which ones AI threatens. It's no longer enough to just own tech. You have to be selective. Internationally, emerging markets had a strong run but pulled back after the Middle East conflict escalated. The earnings story there is still compelling, but near-term risks have increased. And on the bond side, credit spreads are near historic lows, meaning you're barely getting compensated for taking on credit risk. And that's something we've been proactively addressing in your portfolio. So here's what matters most. What are we doing with your portfolio? The short answer is we're staying invested, but we've meaningfully refined how we're taking risk. We still have an overweight to equities because the fundamental backdrop supports it, but the market has changed. The regime that rewarded big, concentrated bets is giving way to one that rewards being more selective and more diversified. So that's exactly what we've done. We've reduced concentration in mega cap names and shifted towards a more actively managed, fundamentally driven approach. The top 10 stocks now make up nearly 40% of the S&P 500, double what it was 15 years ago. History tells us that when concentration gets this extreme, the broader market tends to catch up. We want to be positioned for that. Our conviction on AI hasn't changed, but how we invest in it has. The first chapter was about infrastructure builders, the chip makers, the data centers, and that's still important. But the next chapter is about companies using AI to build real competitive advantages, the ones improving their margins, redesigning their workflows, pulling away from competitors. A Boston Consulting Group study found that only about 5% of companies are deploying AI at scale. but that group is generating over 2.5 times the return on capital versus the average company. That's where we want to be. It's why we developed the Valor AI Foundation strategy, and it's why we're leaning into active managers who can separate the winners from the hype. We've added exposure to global defense stocks. This isn't a reaction to headlines, it's positioning for what we see as durable multi-year spending cycles. US defense spending has grown 9 years in a row and now exceeds $900 billion. NATO Europe is spending over $750 billion. Modernization is a structural theme, not a trade. And at the same time, we've taken some profits where we've had strong runs, trimming emerging markets in gold. We still like both, but the near-term risk reward has shifted, so we've right-sized. On the fixed income, the move is straightforward. Credit risks are near historic lows, which means you're getting very little extra return for taking on credit risk. So we've drained that risk out of the bond sleeve and rotated into higher quality government bonds. The goal is simple. When equities have a rough patch, we want your bonds to actually act like a shock absorber, not move in the same direction as stocks. Looking ahead, we're watching a few things closely. The geopolitical picture is developing. Energy prices will likely stay elevated relative to the start of the year, and that affects everything from consumer spending to Fed policy. But I want to put it in context. Since 1980, the S&P 500 has been positive 3 years after every major geopolitical conflict. Every single one. These events create real short-term volatility, but they rarely change the long-term trajectory for diversified investors. And we don't think this time is different. Midterm elections will come into focus later this year. Historically, midterm years tend to be choppy, but markets typically rally into the fourth quarter as uncertainty clears. We don't position portfolios around politics, but we're aware of the pattern. And the biggest theme of all, AI is still very early. The capital being deployed into semiconductors, data centers, energy infrastructure, and compute is massive and multi-year. The companies that figure out how to use these tools effectively are pulling away from the pack. We think this theme defines markets for the rest of the decade, and we're positioning for it. Here's the bottom line. We're constructive, we're staying invested and staying disciplined. We've refined the portfolio to be more selective, more diversified, and better prepared for shocks, with real upside participation and improved ballast on the downside. As always, your advisor is here to talk through how this applies to your specific situation. Thank you so much for the trust you put in Prosperity. We take it seriously and we'll keep working to earn it.